When interest rates fall, money itself seems to change character. What once felt heavy suddenly feels light. What was once locked away suddenly moves freely. Opportunities that seemed far out of reach just a few months ago begin to feel possible. But here's the part most people don't realize. By the time the headlines announce rate cuts, the wealthy are already in motion. They didn't wait for the news. They've been preparing for this moment all along. That's why I want you to watch this video until the very end, because we're going to uncover not only how the rich position themselves when interest rates drop, but also how you can use the same strategies, scaled to your own level, to build wealth faster, protect yourself, and take advantage of opportunities most people will miss. For the typical household, interest rates often fade into the background. They are merely figures referenced in the evening news or adjustments made by your bank on your credit card statement without much fanfare. For many individuals, it often appears remote and theoretical. For affluent individuals, interest rates serve as important indicators. They serve as indicators, guiding you through the journey of financial prosperity. A reduction in rates not only leads to lower borrowing costs but also indicates a period of expansion, growth, and increased momentum. Make sure to subscribe to our channel and also press the like button to know more financial insights. Consider the economy as a treadmill. When rates are elevated, it resembles navigating a steep incline while carrying additional burdens. Each step can lead to exhaustion. Debt can be burdensome. Credit cards can deplete your finances more quickly. Mortgages can often seem overwhelming. When interest rates decrease, it can feel as though the burden has been lightened, making it easier to manage your financial obligations. All of a sudden, each step yields greater results with the same level of effort. That's the reason markets experience a surge when rates decline. Businesses find relief, investors return enthusiastically, and capital starts to circulate once more. However, there is an important consideration to keep in mind. Those with financial acumen are already aware of their direction when the pace quickens. They have carefully assessed the landscape, identified potential opportunities, and built up their cash reserves. In the meantime, many individuals are left pondering, how does this impact my situation? In that moment of uncertainty, the distance increases. What strategies do affluent individuals employ for their preparation? Let's analyze the details. Initially, they focus on solidifying their base during a time when capital is costly. This may seem counterintuitive to many individuals. During periods of elevated rates, many households express concerns regarding their debt levels and constrained budgets. However, they often fail to implement necessary adjustments. The affluent take a different approach. They enhance their financial profile. They are actively reducing their outstanding balances. They safeguard their credit score with the utmost diligence. They accumulate what is referred to as dry powder cash reserves that are not utilized but are maintained for potential opportunities. When banks eventually relax their lending criteria, those who appear most financially stable will be prioritized by lenders. Secondly, affluent individuals proactively identify opportunities ahead of time. They proactively explore options rather than waiting for rates to decline. They are aware of the neighborhoods poised for growth as mortgage rates decline. They have insight into which companies are poised for rapid growth as borrowing costs decrease. They have conducted thorough research on the asset classes that are poised to perform well when the Federal Reserve makes a shift in its policy. Consider it akin to a strategic game. They analyze the situation thoroughly before taking action. Additionally, they implement a comprehensive strategy consisting of three key components: offense, defense, and efficiency. Offense refers to the strategic use of affordable capital to grow, acquiring additional real estate, scaling operations, and investing in assets that are now advantageous due to reduced borrowing costs. Defense involves securing more favorable rates, refinancing obligations, renegotiating terms, and reducing expenditures that previously hindered progress. Efficiency involves making sure that every dollar saved is effectively utilized, automating investments, reallocating idle cash into higher yield accounts, and creating systems that can expand without the need for continuous effort. This is where many individuals encounter challenges. They focus on defense. They take pride in their lower mortgage payment or decreased car loan, yet they allocate those savings towards enhancing their lifestyle. The affluent do not engage in such practices. They strategically allocate every dollar of saved interest into assets. Over time, that seemingly minor difference can accumulate, leading to a significant disparity in wealth. Let's break this down into simpler concepts. Consider two individuals, each facing a credit card debt of $10,000. As interest rates decline, both individuals take the opportunity to refinance their debt into a loan with a lower interest rate. One friend appreciates the reduced monthly payment and allocates the additional funds towards social outings and the latest tech gadgets. The second friend directs those savings towards investments or entrepreneurial ventures. After a decade, one friend finds themselves in debt again, whereas the other has successfully established an asset portfolio that produces income. The sole distinction lay in the manner in which they capitalized on the opportunities presented by the declining rates. It's understandable to wonder, that approach may work for the wealthy, but how does it apply to my situation? The reality is, you don't require a fortune to implement this strategy. A strong mindset is essential for success. When managing high-interest debt, it's crucial to take advantage of the first opportunity that arises when rates decrease by considering refinancing or making significant payments to reduce the balance. Taking that initial step has the potential to yield significant savings in the long run. Now is the ideal moment to enhance your credit, as financial institutions tend to prioritize the most dependable borrowers when they begin to ease lending practices. When it comes to accumulating cash, it's important to note that you don't need to reach hundreds of thousands. Even having a few $1,000s set aside can empower you to take action when others may not have the means to do so. This is the point at which a change in mindset occurs. For the majority, reduced rates signify a sense of ease. For those with substantial resources, it signifies growth opportunities. Relief expresses, "I feel more at ease with my finances this month." Expansion states, "This is an opportunity to capitalize on for future growth." A single shift in perspective can transform your entire approach. Consider lower interest rates as a shift in the economic landscape. When your preparations are in place, opportunities can propel you toward success more swiftly than you anticipated. However, if you fail to take the necessary steps, you may find yourself stagnant while others progress ahead of you. The distinction lies not in chance, but in preparation. Now, let's analyze the dynamics at play within the economy. On Wall Street, declining interest rates often lead to market rallies, as the availability of inexpensive capital enhances the appeal of taking on risk. In the real estate market, we are observing an influx of buyers taking advantage of the current affordability of mortgages. In the business landscape, expansion accelerates as borrowing becomes more affordable. For individuals, now is the moment to harmonize with the current rather than oppose it. Consider allocating funds to the market, exploring a side venture with a modest, affordable loan, or even discussing a salary adjustment during a period when businesses are more optimistic about hiring and growth. Now, watch the video appearing on the left side to know the signs that show you're doing better than average Americans financially. Also, subscribe to our channel to help us complete our goal of 10,500 subscribers.